Ever ask yourself, how do banks make money? Like, really make money? Because it looks simple. People deposit money, banks help, then everyone's happy, right? Yeah, not exactly. The truth is, banks are running a whole money machine. And once you see the gears, it feels less like a mystery and more like a business. So today, I'm going to explain top 5 ways banks actually make money in the USA, plus what they don't tell you as casually. Let's go. Top 5, how banks make money. Number 5. Interest margin, the classic borrow cheap, lend dear engine. Okay, this one is the headline act. Banks take in money from people and businesses, deposits. Then they lend that money out. Mortgages, auto loans, business loans, credit lines, you name it. Here's the key. Banks earn the spread between what they pay for deposits and what they charge for loans. That spread is often called the net interest margin. But the idea is super simple. Put money in a savings account. They pay you a small interest rate, usually not amazing. They lend money to borrowers at a higher interest rate. Those borrowers pay a bigger interest rate. Difference? That's profit. Think about it like a store. They buy funding from depositors, then sell loans to borrowers. Now, here's where it gets interesting. When interest rates rise, sometimes banks earn more on new loans, but sometimes they also have to pay more to keep depositors. So the profit doesn't automatically go up in a straight line. Banks are always managing that balance. Number 4, fees. The everyone pays something business model. Next, fees. People hate this part, which is fair, but fees are a huge part of how banks earn money, especially when interest margins get squeezed. Banks charge fees like monthly account maintenance fees, ATM fees, overdraft fees, wire transfer fees, account transfer and closing fees, merchant fees, late payment fees. Now, a big misconception is that banks are making money by charging you random nonsense all the time. Sometimes they are, but often it's more like this. Banks design pricing to match risk, cost to serve, and regulations. Fees aren't just greed. They're also how banks cover operations and risk costs when interest income isn't enough. But here's the reality. Regulation has cracked down on certain overdraft and fee practices over the years. So banks constantly adjust. They try to maintain revenue, but in safer, more regulated ways. Number 3, credit card profits. Interest plus interchange. All right, this is where it gets interesting. Credit cards are basically a money machine for banks. How? 2 main ways. First, interest on unpaid balances. If you don't pay your credit card balance in full, you get charged interest, and that interest is usually high. Banks earn more when more people carry balances stay longer, default risk stays controlled. Second, interchange fees. When you use your card at a store, the business pays a fee. A part of that goes to the bank that issued your card. So the setup is simple. Banks make money when you use your card, and they make even more if you don't pay it off quickly. But here's the other side. If too many people don't pay at all, banks lose money, so they balance profit with risk. Number 2, investments, using deposits to earn more. This part surprises most people. Banks don't just store your money in a vault, they use deposits as funding. Then they invest that money in things like government bonds, mortgage-backed securities, corporate bonds, and other interest-paying assets. When these investments earn interest, banks make money. But there's a catch. When interest rates change, the value of these investments can change too. So banks constantly manage risk. They're not just earning, they're protecting at the same time. Number 1, business services and big deals. Now this is the part most people don't see. Banks don't just deal with regular customers. They also work with big companies. And this is where serious money comes in. Banks earn from helping companies raise money, advising on mergers and acquisitions, trading and market making, wealth management services, business payment systems, cash and treasury management. These services can generate huge revenue, and they're not always tied to regular deposit or loan rates. So even if one area slows down, another might keep profits strong. Banks are not one-trick businesses. They have multiple income streams running at the same time. Now, before you think banks are just printing money, let's talk about the other side. Because banks also have major costs and risks. They pay interest to depositors, they spend money on employees, branches, and technology, they deal with borrowers who don't repay loans, and they follow strict regulations. So profits come after all of that. Let's simplify everything into one idea. Bank income comes from interest fees, card revenue, investments, business services. Then they subtract operating costs, loan losses, funding costs, regulatory requirements. Now let's connect this to real life. During a recession, people may struggle to repay loans. Spending slows down, business activity drops. So banks can lose money in some areas, but not all banks are affected the same way. Some rely more on loans, some rely more on fees, some rely more on investments. That's why different banks perform differently. Now let's clear one big myth. People think banks directly loan out your exact deposited money. That's not how it works. Your money goes into a large pool, and the bank manages that pool across loans, investments, and liquidity needs. So your deposit is part of the system, but not tied to one specific loan. Let's make this simple with a story. Imagine a bank as a person managing money. They have three buckets, one for deposits, one for loans and investments, one for income. Their job is simple: grow income, manage risk, keep everything balanced. When the economy changes, they adjust strategy, they lend less or more, they change interest rates, they shift investments, they prepare for risk. That's why banking always looks like it's changing, because it is. Quick recap. Banks make money from interest margins, fees, credit cards, investments, business services, and they manage risks at the same time. Now here's the important part for you. Why should you care? Because this helps you make smarter decisions. You'll understand why loan rates change. You'll avoid unnecessary fees. You'll use credit cards more wisely. You'll understand how the system works. And once you understand the system, you stop being confused by it. So, let me ask you something. When you hear banks make money, what do you think is the biggest source? Interest? Fees? Credit cards? Drop your answer in the comments. And if you want the next video, I'll break down how banks set interest rates and why your savings account still pays so little. Go ahead, comment your guess.